Wall Street. It's a world of high-stakes deals where fortunes are made and lost in the blink of an eye. Beyond the glitz lies a complex ecosystem driving the global economy. Wall Street is the collective term for financial institutions, stock exchanges, and investment banks forming the backbone of the global financial system. Located in New York City, Wall Street symbolizes American capitalism and the relentless pursuit of profit. This small street in Lower Manhattan attracts the brightest minds and the most ambitious individuals from around the world. The history of Wall Street dates back to the late 18th century, when traders gathered under a buttonwood tree to buy and sell securities. Today, Wall Street remains the epicenter of global finance, influencing businesses and individuals worldwide. At the heart of Wall Street lies the stock market, a dynamic marketplace where ownership shares of companies are bought and sold. For companies, the stock market offers a vital source of capital for expansion, research and development. By issuing stock, companies tap into a vast pool of investors, fueling innovation and economic growth. However, the stock market is a double-edged sword, exposing companies to investor scrutiny and market volatility. A company's stock price reflects its perceived value, fluctuating based on earnings reports, economic conditions, and investor sentiment. For individual investors, the stock market offers a chance to build wealth over the long term. By investing in a diversified portfolio of stocks, individuals can benefit from overall economic growth. However, investing in the stock market carries inherent risks, and predicting its movements with certainty is impossible. In the labyrinthine world of high finance, hedge funds stand out as both alluring and enigmatic. Unlike mutual funds, hedge funds cater to high-net-worth individuals and institutions, utilizing complex strategies to generate high returns. One controversial strategy is short selling, profiting from the decline of an asset's price. Short sellers borrow shares, sell them, and buy them back at a lower price, pocketing the difference. While short selling can be legitimate, it can also manipulate markets and exacerbate downward price spirals. Hedge funds argue their strategies contribute to market efficiency by identifying mispriced assets and providing liquidity. However, critics point to their role in exacerbating market volatility and potential systemic risks. Towering over the financial landscape are the major banks, indispensable to Wall Street's functioning. These behemoths act as intermediaries, connecting borrowers and lenders, facilitating transactions and providing a wide range of financial services. Investment banks specialize in underwriting securities, advising on mergers and acquisitions, and trading in capital markets. They help companies raise capital through stocks and bonds, facilitating the flow of funds from investors to businesses. Commercial banks provide banking services to the public and businesses, such as accepting deposits, making loans, and processing payments. However, the immense power of these banking giants can create systemic risks, as evidenced by the 2008 financial crisis. The 2008 collapse, a crisis of confidence. The year 2008 will forever be etched in financial history as the year the global financial system teetered on the brink of collapse. The crisis, rooted in the US housing market, exposed the fragility of a system built on excessive leverage and complex financial instruments. At the heart of the crisis lay subprime mortgages, loans extended to borrowers with poor credit histories. These mortgages were bundled into complex securities known as mortgage-backed securities and sold to investors. When the housing bubble burst, defaults on subprime mortgages surged, triggering a chain reaction throughout the global financial system. Financial institutions faced staggering losses and credit markets froze as banks became wary of lending. The crisis morphed into a global recession, with businesses struggling to obtain credit, consumer spending plummeting, and unemployment soaring. Regulatory measures. Reining in the bull. In the aftermath of the 2008 financial crisis, governments implemented regulatory measures to prevent a repeat of the meltdown. The crisis exposed weaknesses in the financial system, highlighting the need for stricter oversight and greater transparency. One significant piece of US legislation was the Dodd-Frank Wall Street Reform and Consumer Protection Act, addressing systemic risks. Dodd-Frank aimed to strengthen financial regulations, increase oversight, and protect consumers from abusive practices. Among its key provisions, Dodd-Frank established the Financial Stability Oversight Council to identify and respond to systemic risks. The Volcker Rule restricted banks from engaging in proprietary trading, preventing speculative bets with depositors' money. FinTech revolution: Wall Street in your pocket. While governments grappled with the financial crisis aftermath, a technological revolution was transforming the financial landscape. Driven by the internet, mobile technology, and big data, FinTech has democratized access to financial tools and services. FinTech encompasses innovations like mobile payment platforms and robo-advisors, disrupting traditional financial services. Online brokerages have made it easier and more affordable for individual investors to buy and sell stocks and bonds. Robo-advisors provide automated investment advice tailored to an individual's financial goals and risk tolerance. Peer-to-peer lending platforms connect borrowers and lenders directly, offering higher returns for investors and alternative credit sources for borrowers. The future of finance, innovation, and uncertainty. The world of finance is in constant flux, shaped by technological advancements, evolving regulations, and shifting economic landscapes. The future of Wall Street, once a fortress of power, is now a subject of intense speculation and debate. FinTech is challenging Wall Street's dominance, empowering individual investors and disrupting established business models. The lines between traditional financial institutions and tech companies are blurring as both leverage technology to enhance offerings. Wall Street remains a formidable force, adapting to changing times and embracing technology for growth. The future of Wall Street will be shaped by technological innovation, regulatory reforms, and evolving investor needs, presenting both challenges and opportunities.